Silver and gold prices both exhibited some strength this week, particularly to close the week with gold spot price at $1,250 per troy ounce. Silver spot price up nearly 50 cents on the week, closing at $14.68 per troy ounce. With us this week, a new guest who will take us back in time to his beginning days in the 1980s COMEX NYMEX futures contract trading pits. As well, we'll discuss current ongoings with the US dollar, the euro, crude oil prices, growing federal and consumer debt levels, especially all in relation to the recent inversion of short-term US bonds versus longer duration IOUs. As well, we'll discuss both his up and potential downsides for gold prices for the coming years. His commentary too on silver, platinum, and palladium are all worthwhile as well. Before we begin, a major announcement from our sponsor. SD Bullion is now offering discreet, fully insured free shipping for all domestic USA bullion orders over $99 in value. These lower shipping rates coincide with SD Bullion's 2018 holiday guide and 12 days of Christmas bullion deal promotions. With over 100,000 customers and 10,000 positive online reviews, visit SD Bullion for both great customer service as well as the lowest price period.
Welcome to this week's Metals and Markets Wrap. I'm your host, James Anderson of SD Bullion. With us this week is a new guest to the show. He is author of the 2007 book called Gold Trading Boot Camp. He's the purveyor of WeldonOnline.com and a financial veteran with over 3 decades experience. Mr. Greg Weldon, thank you for taking the time to come and speak with me and our listeners.
My pleasure, James.
So, Greg, I just wanted to give a brief introduction, if you wouldn't mind taking us down that road to kind of go back in time, kind of how you got involved in the financial industry and what that was like.
Well, it's interesting because it's a good question. Wow. Okay, so yeah, we go way back, man. 34 years. Okay, I was out of college, went to Colgate University, studied English literature. What are you really going to do with that? So I didn't know what I was going to do, and it was per chance. Okay, and I was visiting a friend of mine from high school. It was his birthday, and he worked on the floor of the COMEX as a clerk in the gold pit, right? Mm-hmm. So I go down on a Friday, maybe 15 minutes. He's like, you got to come down here and check it out. Come like 15 minutes before the market closes. I did. I'm like, holy mackerel. I mean, the electricity, the energy, through the roof, the money, the stuff flying around, the physicality of it all was, really intoxicating. So at any rate, I go in, I watch the action, the market closes, and of course, this is when everything's on paper. Let's not forget that everything is a slip of paper. Mm-hmm. He has to do his little write-up, now that the market's closed, to send downstairs to get reconciled. So I'm standing there, and just by the pit, it's empty now. I mean, there's people milling all around. And this older dude, which almost my age now, came up to me. And he asked me about playing basketball because I'm 6'10", I weigh 275 pounds. I played at Colgate University, and that was back in the day when we played a lot of independent schools. So, I mean, I have good experience playing against a lot of guys who made it to the pros. Mm-hmm. So I'm standing there, and, he was 6'4", and he started telling me about playing basketball in Madison Square Garden at NYU. When in the 40s, that was the mecca of basketball, right? So we had this pretty tight connection. We talked for a few minutes. And my friend's ready to go, and we start to leave. We walk halfway across the CEC floor, which is huge. And I said to him, I go, man, this place is amazing. How did you get your job? How do you get a job down here? And he goes, you got to know someone. And I said to him, well, don't you know anyone you can maybe introduce me to? And he goes, well, that guy you were just talking to owns the largest firm on the floor. I did a foot plant, change your life moment, turned around and went back and asked him to hire me. And he literally hired me on the spot. Because at 6'10" and 275, I could stand there and pass paper over people's heads and see over people's heads. And, so trial by fire, because I knew nothing. And they stuck me right in the middle of it all. Yeah. Like jumping over, a whole bunch of other people that worked in this firm. And it was like, oh, my God, trial by fire. But, part of the point, too, is I would never have that opportunity now.
Mm-hmm. Yeah. I mean, I've heard just through rumor that a lot of times people would hire former athletes in the pits back when they were old on the paper because big guys, had a better chance of handing out paper, et cetera, and doing the point jobs that you were describing in your book.
Yeah, it was a totally inappropriate workplace. I mean, beyond what that would ever mean now, too. It's incredible to think back, too. Very few women worked there because it was brutal. I mean, these guys were like, the masters of the universe kind. And, I got along with everybody because I'm just, who's going to mess with the 6'10", 275 guy? So I'm just a gentle giant. I never got any problems. But, man, I saw some vicious fist fights and, a lot of pushing and shoving. And all right, so I'll extend this story further. Not that this is what we want to talk about, but you can edit this out if you want.
Sure.
This was Friday afternoon. The guy hires me, and I'm like, I called my job. I was working in telecommunications, the wave of the future, and I hated it. And I called my job and I quit from that same moment, from that booth. I'm like, this is going to be my future. So I came in Monday. Stanley's there. Stanley Bell was his name. Bell, it was one of the biggest firms on the floor. And he takes me the first day, Monday. Next Monday, I come in and he takes me aside. We watch the market open. He's explaining to me the phones, or overseas banks, and you got ARB to Chicago. I mean, all these things were big back then. There were a lot of inefficiencies in the market you could take advantage of. But he just showed me who the players were, what the action was, and my question to him is, but what determines the price of gold? That was my first question. What is it that makes gold worth 320 or 460 or? So we had that discussion, which was interesting.
Mm-hmm.
And he takes me for, breakfast at 11 o'clock to the members' dining room. We sat down and he said something to me that links back to your professional athlete. He says there's 3 ways to make a lot of money in the U.S. to be, a Hollywood movie star, professional athlete, or work here in this business right here. And it was the place to make the most money, as quickly as you might potentially make it, was a place like this. So he then says to me, it's just, 11:30, he goes, okay, you've had enough for your first day, go home. I'm like, what do you mean go home? He goes, go home. I went home, and I'm like, holy shit. So I went in the second day and Stanley wasn't there. He didn't go every day. He was, 70. So they didn't know what to do with me. And so the one guy goes, well, put him downstairs in the write-up room. So I go downstairs into the write-up room. And this is the first day, the first hour. And I mean, so they're showing me how you write up the tickets and this, that, and the other thing, because they had to train me. It's not like they're going to literally put me right in the middle of this, untrained. Mm-hmm. Or so I thought. Because all of a sudden, I mean, literally the floor above the ceiling, which was the floor,
mm-hmm.
It's just a shake. I mean, it's moving, it's vibrating. And you see people start to scurry. And all of a sudden, people are running up and down the stairs. The phones are ringing. Something's going on, right? So the phone on the desk, and it was Stanley's sons ran the company. His one son was the lead trader, Craig Bell, legendary guy, unbelievable. I mean, he just had so much respect from everyone. And then the older brother, Teddy Bell, worked the desk underneath in the write-up room. So Teddy Bell, the phone rings, Teddy Bell answers the phone. All I hear on the other side of the phone is, get that big MNFer up here right now, right?
Yeah.
So they sent me upstairs and they put me in the point because it was so crazy that I could just hand paper and body people out of the fucking way. Excuse my language.
It's okay.
I could body people out of the way, and I ended up literally jumping over like 20, 25 guys that were working there, all of whom wanted to get to the point, because the point where you handle all the paper, the whole deck, up and down, the stops, everything, and I knew nothing. And I had to learn all this stuff literally, on the fly. And I kept that job for like a year and a half before, and the whole idea was to move into the pit. And that was the next spot from which the next broker in the pit would come, was the point. So, all that happened, within a 3-day period.
Mm-hmm. And you did mention in your book that you could kind of see the writing on the wall, the volume was kind of drying up, and you kind of made a drastic move in your career just a year and a half later, correct?
Yeah, 80% pay cut, from around 150 down to 30.
Wow.
And, I started at 13. So remember, this is in the 80s. So, 150 for 20 something in New York in the 80s was massive, man.
Yeah.
So, we live large, but at the same time, you could see it, you could feel it. It's one of these things you just have some instinct or feeling for things, and you sense them. You use your inner senses. They're very valuable. And, I do a lot of research on this kind of thing now because it's pretty amazing when you start to break down what the brain is capable of doing. So, but, back then you're in your 20s, but it was a feeling. And one of those things where the Swiss franc, was the biggest futures market outside of gold back in that day. All right. So that gives you perspective. None of these other things existed. The S&P 500 was barely a year old when I started.
Right.
All right. So that's perspective to me. And it was just obvious when the Matif and the Life and they started trading European bonds and European stock indexes. I'm like, this is going to be way bigger than the precious metals. I got to make a move. So that's when I went to Lehman and happened to be with another legendary guy, Howard Levine, who was a great broker at Lehman Brothers. So I learned a lot from him too.
So the Lehman move, and it sounds like in 1986 roughly, was a move to kind of learn macroeconomic theory and kind of how you do analysis on a macro level.
Well, no, I mean, it was to get exposure and learn all of that, but to have exposure to these markets and the players and the whole 9 yards. It was really bigger than that. Lehman's trading floor, they have foreign exchange down there. And then you start to talk about such another universe of, information that's to be processed and used to make decisions. And of course, it wasn't too much of a downer of the electricity from the trading floor either. It was pretty electric there as well. But the point came was, understanding as the main guy on this broker's desk. Like the first time I went in for an interview, he didn't hire me. He says, "You're way overqualified." He goes, "You'll steal all my business." And he says, and I mean, this is going to be sexist, but he says, he hires women because women will do a great job for him. And then, he hires married women to go out to get pregnant at a certain age, and he doesn't feel a threat to his business. Right. All right. So, understanding how ridiculous that sounds. All right. But this is why he didn't hire me the first time. And then like a month later, he called me and goes, "Okay, you got it," because whoever he had hired had not worked out. But I went into a situation where it was a whole nother trial by fire because his customers were big. They were Commodity Corp. All right. Michael Marcus. I mean, Ed Sakota. I mean, these big names that I got to know too. So that's a big part of my development is I probably worked with half a dozen of the Hall of Fame greatest traders of all time. Louis Bacon, Ed Sakota. I mean, the guys I'm talking about here. So in that context, I didn't know soybeans. I sit down and the phone rings and this huge guy. The guy has a huge position. He's a big trader at Commodity Corp. Grenville Craig or somebody like that. And he's like, "What the hell is going on in soybeans? I got to know." So I had to learn all these markets and I had to know exactly what was happening day by day in all these markets. It was an unbelievable over-the-top education. And to me, that's why I believe now to this day that everything matters. I mean, you got to find all the little things and dig deep and then connect all the dots and then try to have some vision as to what might happen. You play out various scenarios in your head. And then when one of them starts to play out, you kind of recognize it because you've thought about it already and you kind of know what you're prepared to do in that situation. So,
yeah,
all that, in terms of the macro and the risk management, that was all Louis Bacon when I worked at More Capital. And that's what I went off on my own after that.
So just a question about, obviously this experience that you had in the 1980s, it's definitely applicable to today, but obviously the markets are a lot different in the sense that, we're not working on paper and we're not in pits physically as they were back then. What are the similarities or glaring differences that you see maybe between now and versus then?
Well, straight up human psychology. I mean, this is something that hopefully is evolving, but doesn't really seem to change. All right. So the evolution is probably such a much longer term thing that in one lifetime, you can't expect to see too much change in human psychology, pure behavior, and, all the things that are associated with why you can have a set of rules that are proven to work and potentially not be able to follow them. Mm-hmm. So it's that kind of thing. That's where it comes down to the psychology of trading, which is just the key. I mean, it's difficult, but what you have to do is develop a methodology that you have belief in, that you can follow when it's at its worst, because it's a distribution curve. It's a wave. There's ups and downs. I mean, there's no, you kind of want to be systematic. We try and use a systematic basis and then make discretionary decisions on top of that using it's top down global macro. Everything matters. And then it's bottom up, micro technical. So, we kind of want to drive the actual trading ins and outs, the execution of the trades. We kind of want that to be very much more technical, while the ideas for the trades definitely come from the top down because it's all thematic and you will create a portfolio that's kind of in sync, although sometimes you want something that doesn't fit. So you kind of look for that too. Mm-hmm. I mean, recently in this decline in the metals, that something was palladium. So that's, pretty glaring.
Yeah.
And for very good reason too. I mean, it's a pretty straightforward fundamental there. So
yeah, just swinging it back toward today, like you just did. I mean, this past week, for instance, we had big news about the 2-year and the 3-year bond inverting versus a 5-year bond. What is that significant to you in your outlook? What is the bigger picture here on that news story?
Well, I mean, that's the $64 million question everyone's asking right now. I mean, my problem with thinking too much into what the curve inversion or not means mm-hmm. is that it is a function of mispricing in the treasury market that really goes back to when the Fed kind of came out of QE. I mean, when taper were led to tap out in August 2014, They took their dot plot to a level that was like 3.5% Fed funds by the beginning of 2017.
Right.
So they've always been more hawkish. And, in that vein, you kind of, the Treasury market didn't follow. So it was interesting because the Treasury market had been right all along versus where the Fed was, whether it be the Fed funds futures, the Eurodollar spreads, or whether you even looked at the yield curve.
Mm-hmm.
So in that vein, when the Fed, there was a key moment in September of 2017, and we were all over this. We did 2 specials as a result of this because it was kind of key, just like Jackson Hole was key for Powell. But this was Yellen, okay, in 2017. And they finally dropped the word normal. They had been using normalize. We're going to normalize rates. That meant nothing. There was no tangible way to measure that, okay, because it really is a meaningless term in the context of what we're trying to use it for. Then when they went to, we're going to go to a neutral policy rate. That changed everything because you can define neutral based on your inflation dynamics, based on where everything was. And what that did was it caught the short end of the curve with its pants down because, the 2-year was at 140. And neutral at that point, we said, and it's been proven out, all right, 2.25 to 250. All right. So at that time, we said, well, if the high end of that range is 250, you give us a 15 basis point VIG on the 2-year note, that's 265. All right. It was at 140. We called for a move to 265. It went to 268. And in the course of doing that, okay, inflation was not higher than that. Inflation was around 2.5. It was 2.4. It got as high as like 2.7, 2.8 in February of 2017, but it came off. All right. But at the same time, the 30-year bond was already at 330. Right. It was already 310 to 330, the 10 or the 30. You can kind of group them together in that range, all right, as the long end. Well, that was still well above the rate of inflation. So that didn't have to move unless inflation did. Right. So the curve flattened dramatically. And everyone said, oh, my God, it's a sign of recession. No, it's a sign that the 2-year note was ridiculously mispriced and went through an adjustment. Now, more recently, it's gotten more tricky because you started to tick up your inflation expectations and expectations for the hawkish Fed with Jackson Hole because Powell said, I'm not Yellen, I'm not Bernanke because I'm not a student of the Depression. I'm a student of the 70s inflation and the poker reaction to that and what happened, all right? As is the new number 2 guy, by the way, okay? They're both kind of students of the inflationary event of the 70s. Which means they're going to try and avoid having that happen again. And they said it very clearly. We're going to chase inflation higher. Now, luckily, energy prices came down big. So inflation is not accelerating right here. And to me, this is where this new, maybe they pause here. And this is something we've been talking about since August because the economy so shows that it needs it. No more hikes. Look what's happened to real estate. Look with the home builders. I mean, it's very obvious when you break it down. So in that context, I think that it's going to be very interesting. This Fed meeting is huge. People still expect them to hike. I kind of think that there's a bit of a consensus starting to brew that the thought process is they hike one more time and then totally tone down the language. Yeah. That seems likely because that takes them a little higher than where they are. The problem is, I mean, where they are right now at 2.25 as the top end, you could justify going to 2.5 and then you totally neutral right here. For them to say they're going further from 2.5, that's when it would be really bad for asset prices and so on and so forth. Right. So we'll see how this plays out. I think they could hold off in December if they wanted to, and I think the stock market is going to make them do that.
Speaking of the stock market, I mean, I've seen some of your videos that you've recently talked about, growing consumer debt loads in the United States, and obviously, we're a consumer society, and if the consumer starts getting tapped out, that's a big problem. I wonder if you think that the top is in for the U.S. equity markets on a nominal basis, and what's your outlook on the go forward for that?
There's 2 tangents of thought. One is let me deal with the second one first, in my opinion, anyway. So when you talk about the consumer, all right, I mean your first part of the question. When you talk about the consumer, yeah, tapped out. I mean. The creation of debt held by the consumer since the Fed went to tap out, okay, you trace it back to August of 2014. You had 39 consecutive months in that period where the 12-month accumulated rate was of growth was over $200 billion. 39 months. There has only been one other month in history where that had ever happened. Now, I understand the comeback on that is, well, the nominal number is higher. It is. No doubt about that. It doesn't explain the enormity of this increase at all. That math falls way short of suggesting, like you might with China, where GDP keeps growing and people say, well, the growth rate's slowing, where it really doesn't matter because every quarter is a record high in Chinese GDP. All right. And the nominal numbers are so high, you're not going to get the same rate of change. That's not true here in terms of consumer debt. So this is an unprecedented increase. And what's happened more recently, and this is where I've said since August, the Fed is going to face a fork in the road where it's inflation or the consumer. And if they keep chasing inflation higher, they're going to bring the consumer down. And it's going to bring the stock market down. And when it's even the September, I said this in August, even the September hike is probably too much. And the reason is you're close enough to neutral, but the consumer is now paying on a monthly basis $350 billion at an average rate of 16.6 to just float their credit card debt.
Right.
$150 billion is about $50 billion higher than the high prior to the breakdown in 2007 and 8. All right. It is a record high. And when you compare it to retail sales, it's over 2/3 of what retail sales is. At some point, that math doesn't work without crowding out discretionary spending. So again, thank God energy's come down. It might give this might extend the timeline for the consumer. I mean, things change. That's why you got to do this all the time. So that is a bit of a new factor coming in, but it doesn't mitigate the amount of money by far when you break down retail sales of gasoline, which, by the way, we can talk about that because the proportion of the growth in retail sales that is still linked to gasoline sales is too large. I mean, again, that could just, my point here is that even if you get some break from lower gasoline prices, it's kind of just reducing what is already an imbalance against the consumer. Right. So it might provide some relief, but it's not like a boon like it might otherwise be. It's not a tax cut decline in energy, not yet. I mean, you go further, it would be.
Nor is it a correction or even a drawdown, of course. It's just it's a temporary, reprieve, I suppose.
Oh, well, you can make that case. I mean, we could talk oil prices, for another hour.
Yeah, of course. Now, I've seen you talk about this. I mean, in the on the longer run, when you look at central banks, when they look down the rabbit hole, they obviously we have so much debt, obviously, in the globe, almost 250 trillion when you add up all the various debts around the world. It's record levels, and then you look at the U.S. federal debt. Obviously, it's going to hit 22 trillion pretty soon. Then the unfunded liability pile, it's multi-hundred trillion if you take Dr. Kotlakoff's word of it, in net present value. So, I mean, you've talked about release valves. What is the release valve here? Is it the U.S. dollar? Is that ultimately what we're looking at, where, the U.S. dollar, maybe it strengthens in the short to medium term possibly, but ultimately, is that the release valve for this?
Yeah, it is. It's the relief valve. And I mean, and the reason it's the relief valve is because it always is the relief valve. I mean, yeah. But that juxtaposes you against gold, and that's kind of our bullish case for gold here too. But let's back up and, kind of what's interesting to me is examine why right now it's the only relief valve of any significance. All right. And when you talk about debt, that ties in perfectly to take us to Europe, all right, where the debt is growing, where you have a situation in Spain that is totally really undervalued for its risk factor in the sense that socialists have been controlling the country now since June. I mean, it was overshadowed by the Italian elections, but it was equally disjointing to Europe to see the socialists take over Spain, especially because the socialists to take power had to include the Basque Party and the Catalonian separatists. Right. So the bottom line is both Spain and Italy, the two real powder kegs of debt, all right, have now, gone into a fractured political state, meaning fractured in the country and fractured in terms of a potential separation from Europe, at a time when, the ECB is petrified to even take rates to a less negative place. Holy mackerel. What does that tell us about what the banks could be? I mean, oh my God, you want to talk about debt? I mean, Mario Draghi went from being Super Mario, okay, when his call will do everything to save the euro, to right now his legacy is going to be scrutinized. And I respect him. This is not a knock on him. But, the ECB should have raised rates when they had an opportunity, which was probably, really earlier this year when you had strong GDP growth. Spain was cooking, Germany was cooking, Czech Republic was cooking. All the offshoots from the German export juggernaut were cooking. Poland, Hungary, and the Czech Republic. All right. And they had an opportunity. Inflation was high. I mean, above 2%. They had an opportunity to take rates to zero. That's all they had to do, and they didn't. What are they going to do now?
Mhm.
What are they going to do now? Are they going to say, we'll keep buying bonds past the end of December? Do you think that's going to have an impact? I don't think so. And when you start to talk about where is the market structured, okay, the 2-year Schatz yield in Germany is minus 75 basis points, which is below the minus 40 basis point official policy rate by 35 basis points. And on a real basis is more than 300 basis points negative.
Mhm.
To me, that's physics saying you can't stretch this much more. So, man, you want to talk debt, risk, and a central bank that is absolutely paralyzed. Let's talk Europe. It's a powder keg, man. So that's a whole nother place.
It's risky though, in the sense that euro is the second largest fiat currency in the game, right?
Well, that's half the point. I mean, if all of a sudden you're using the dollar as your relief valve, but no one wants to hold the euro,
Right.
what are you going to hold? Hello, that's why we're bullish on gold.
Yeah. So turning to gold, would you mind giving us your current downside risk versus, upside, maybe medium term, even in the long term, I suppose?
Well, I mean, the downside risk here is now significant. And it's not that it's significant in the sense of what you might think that to mean. It's significant in the sense that if you break from here, it's a failure, which means you probably go all the way to dip below 900.
Mhm.
All right. You might not have said that a few weeks ago when you were 1160. You could see it dip to 1050 and holding. I think if you were to break that level now, 1160, that would be such a technical break and such a failure again in what has become the perfect setup again. You've been here once before and it didn't work, but that's okay because the dollar wasn't ready. And we actually said earlier this year in February, I don't want to sell the dollar at 88. I want to sell the dollar at 96. And that's what we got. That's the opportunity. We've been presented this opportunity here. So we've been patient. That's required always. And in this sense, the setup from a technical structure perspective on gold specifically, all right, above 1265 gets you to 1365.75, which is a massive secular multi-decade bull market breakout level. So if you get a kind of rally up in here a little bit and then fall back below 1160, then your downside's 890.
Yeah.
So, but your upside's new highs if this plays out, in 3 to 5 years. Now, that gets back to what's the same, what's different. And the very first question you had, or the first comment you had, was about 2007 and the book. So in the book, I wrote, you are facing a consumer, real estate, mortgage, whole 9 yards. We wrote the book in 2006. It finally got published early 2007. So either way, well ahead of the curve. And specifically said, and I remember going on CNBC, all right, on Squawk Box. And it was to promote the book. And, they asked me questions and said, well, you're facing such an issue of debt with the consumer when it comes to mortgages and how they're over leveraged and the whole 9 yards. They borrowed against the unrealized paper profits in an asset they thought the price of which would never go down.
Right.
You have done exactly the same thing here with the stock market. That's the connection here. When you go back to 2007, when I'm on Squawk Box and saying, hey, the Fed is going to have to buy treasury paper, monetize debt, and gold will triple in price. And if I tell you, I virtually got laughed off the set. I went back to the green room and I heard, some comments. I won't say who said this, but like, oh, we got all these crazy gold guys coming on, and and I was just like, crazy gold guy. I mean, whatever. So anyway, the fact of the matter is, I saw that same gentleman, believe it or not, at CNBC in the studio in the men's room. Okay, so he's at the urinal. There's only two. I come walking up, and again, 6'10", 275. You're not really seeing me when you're on stage sitting down like that. And I turn to him and I say, hey, how you doing? Remember me? And I mean, literally, we had a pretty pleasant conversation. By the end of the conversation, he was inviting me to play golf. So
yeah, right.
But the point is, it's the same setup now.
Right.
But central banks have so much less firepower. The math is exponential. You talk about the debt, 10 trillion, 9 trillion, in 2008. All right. It's more than doubled, and it's going to be tripled probably within the next 5 years. All right. So in terms of the Fed balance sheet, what they might have to do, if you want to look at it that way, because you said about going down the rabbit hole.
Yeah.
The bottom line is, when facing the abyss of a debt deflation, they'll choose to do whatever they have to do to try and reflate. That's the whole premise of it all. The question is, when does it stop working? It's like the 1969 thing where it was the Vietnam War. protest, and the flower child with the bandana and was putting the flower in the guy's gun. All right, and it was what if they gave a warrant, nobody came? Well, what if they gave QE and nobody cared? I mean, because this could be because you have to do so much now to get the same percentage effect money-wise. It's that simple. When you're talking about taking the balance sheet, doubling it, well, let's talk about taking the balance sheet up by now another $6 trillion. Where's the will to do that going to be? It's not going to be there.
You're talking in terms of diminishing returns. Right now, the federal
Yes.
balance sheet's maybe 3.8 trillion. Let's take it to 10. What's that look like for the stock market? I mean, I'm guessing in that scenario, they are propping up the stock market effectively.
Well, exactly. And the question is, I mean, if they have the will to say we're going to take the balance sheet to 10 trillion, well, I mean, first of all, I guess the first analysis is that enough? All right. And if it's deemed that it is enough, and that would be questionable, frankly, as I actually start to kind of consider that number when you compare it to all the debt out there, because I don't think any other central bank can necessarily do that to the same effect. The European Central Bank has too much restrictions. They are tethered in too many different directions to have the same flexibility as the Fed. So, and that's evident here, because if the ECB was linked to Germany, they would have hiked rates multiple times already.
Right.
So this is the issue. They're petrified of what's happening in the South. But to kind of link it all back, it still comes back to the consumer and the amount of debt that they have now borrowed against the rise in the stock market. So, and they've been conditioned to think it's going to dip and it will come back every time. It's something that can't go down in price. We have massive unrealized profits. Let's borrow against that. We'll never go upside down again.
Right. Yeah, that sounds like a good plan.
Human psychology. Of course, that's the way it's going to play out.
As far as other precious metals, do you key on any others? Are you watching silver, palladium? I think you mentioned earlier, platinum. What are you thinking on those?
Oh, yeah. I mean, we watch everything. I mean, platinum's intriguing to me because, the supply-demand fundamentals aren't positive. And it is so cheap relative to gold. So, wow, it's like almost compelling. If platinum could get out of its own way, I would absolutely love it, because it would have a lot of catch-up to do just for its precious metals, aura, so to speak. Because if you want to break it down, I mean, maybe palladium should be priced higher than gold. Isn't it more rare in the universe? I mean, from a supernova. So these are the kind of things that I think about sometimes too. I mean, it gets a little esoteric, but these are realities that you have to be able to envision anything happening. And in the case of palladium, it's like, yeah, well, anything's happening. And that's not to say palladium couldn't go to $3,000 an ounce.
Right. In 2001, it was 4 times the price of gold at its peak.
Exactly.
Right.
Yeah, exactly. So, I mean, if you look at the spreads, that's where it gets intriguing, because then you look at platinum and it's so cheap relative to gold and thus so cheap relative to palladium. But on the other hand, the fundamentals aren't going to drive you there. So that means investment, and it's too early. All right.
Right.
And you talk about silver, it's kind of in the same boat. I mean, the gold silver ratio is, the highest level in 3 decades. I mean, it's, 28 years, 24 years, something like that.
Right.
So, it is gold. I mean, and we'll see how it plays out. The bigger question is the miners, so, I mean, I still think there's some value there, because I think you'll see continued acquisitions. I think, people say it's just not investable. And that's a valid claim. I mean, that's probably true. Yeah. But that doesn't mean they can't go up in price for some period of time. So
certain ones could certainly do very well, I'm sure.
Yes. I think the bigger name, like the acquirers, will do well. Like American Barrick and Pan American Silver would be, throw two choices. They're obvious names, and I don't normally like obvious names, but in this case, maybe it's just me that thinks they're obvious. I don't know, because no one else is buying them.
Well, Greg, I want to thank you so much for taking the time to talk with me and our listeners. I want to give our listeners a chance to find and follow you if they could. I know you have your 2007 book. It's on Amazon, Gold Trading Boot Camp, if they want to read some of your background and some of your thoughts further. You have weldononline.com, and I think Twitter at Weldon Live. Is that your Twitter handle?
Yep, at Weldon Live, Weldon. And I would also just throw out there that, I mean, we've gotten a lot of demand lately. And I don't know if we talked about this off the air, but we've gotten a lot of demand lately for, kind of how to trade some of these things. And I mean, to me, I'm always a proponent of the futures market, just because I grew up with it. But to me, it's the most liquid. You got a futures contract, you can liquidate and have your money back tomorrow. I mean, that is not really. There's not many investments really, to me, that are just that clean So in that case, unless you're holding gold and silver in your home, the futures market to me is the best way. ETFs are going to be, it's going to be more awkward. It just is. You talk about holding it in a bank. How about a safety deposit box where now, I don't know, people understand Obama's executive, order where they can come into your bank, go into your safety deposit box and clean it out without a warrant.
Yeah, they're not safe. They're not insured, and certainly they can be preyed upon by judges or this or that.
So when you start to take it to the nth degree, all right, outside of, hiding gold in your home in, very interesting ways and creative ways, which I'm a proponent of, frankly. Not that I hold anything here. No, it's all in my office. No, but futures to me is really the way to go. And we have a lot of questions about, the mechanics around futures and approaching futures. And, it is kind of has this mystical, if not opaqueness around it. But to me, once you understand the math around the contract sizes and how to manage the position sizes in your portfolio and so on and so forth, it's actually really easy when you just put together a couple mathematical formulas to look at in terms of what's my exposure. Because people don't understand what they're exposed to necessarily when you buy a contract of gold. They're holding, $120,000 worth of gold. Right. So if you have $5,000 and you want to do that, it doesn't take a big price move to wipe you out. All right, and you got to pony up every day, which is what makes it great, but also leads it to where people get clipped because they're not understanding the math, which is very easy. So we're doing a 4-part series right now. And basically, it's the how-to for dummies. I mean, my book was published by Wiley, so they've been after me to do a new book, but we're starting with the trading series, a 4-part video series. The last 2 parts will be live. We'll actually deal with the markets in real time about how to trade futures, and it's going to be kind of like the how to trade futures for dummies who aren't so dumb.
Great. And how are listeners be able to find that?
Actually, you know what? I mean, if your listeners want to, get involved in that, probably the best way is just to email me directly, which is Greg Weldon, GregWeldon at Weldon Online. And that's one word, weldononline.com.
Well, great. Greg, thanks so much for taking the time again, and we really do appreciate it.
Yeah. Hey, no problem. It was a pleasure, James. You guys do a good job, so happy to be part of it.